Hello friends, welcome you all. Today in this lecture we are going to discuss and study the limitations of analysis of financial statement. In the previous last two lectures we are discussing about the analysis of financial statement, and in the second lecture we have discussed about the applications of analysis of financial statement. In this today's lecture we are going to discuss the limitations of analysis of financial statement. In the previous lecture we have discussed about what is financial statement analysis, and it is the process of evaluating a company's performance or value through a company's balance sheet, income statement, or statement of cash flows. And by using a number of techniques such as horizontal, vertical, or ratio analysis, investors may develop a more nuanced picture of a company's financial profile. We have seen and discussed different types of financial statement analysis, that is horizontal financial analysis, vertical, and ratio analysis. We have discussed some generally accepted accounting principles also, which requires to maintain, or which requires a company to create and maintain three main financial statements. Number one is balance sheet, second is income statement, and third one is cash flow statement. We have discussed about what is horizontal analysis, vertical, and ratio analysis. Horizontal analysis compares data horizontally. Historical data, past data is analyzed in the horizontal analysis. In case of vertical analysis, vertical effect line items analyzed on other part of the business, and means there is the relationship which is analyzed between different type of ratios and different type of financial parameters in the vertical analysis. And in case of ratio analysis, uses some important ratios, metrics to calculate statistical relationship between these numbers. So ratio analysis is a important third type of financial statement analysis. In the financial statement, there are three important statements which are analyzed. Number one is balance sheet, and balance sheet is a report of a company's financial worth in terms of book value. It is broken into three parts to include a company's asset, liabilities, and shareholders' equities. Second is income statement. Income statement breaks down the revenue a company earns against the expenses involved in its business to provide a bottom line, net income, profit, or loss. So the income statement is broken into three parts which help to analyze business efficiency at three different points. It begins with revenue and the direct cost associated with revenue to identify gross profit. And third one is cash flow statement. The cash flow statement provides an overview of the company's cash flow from operative activities, investing activities, and financing activities. So net income is carried over to the cash flow statement, where it is included as the top line item for operating activities. So three activities: operating activities, investing activities, and financing activities analyzed in the cash flow statement. And last one is free cash flow and other valuation statement. Companies and analysts also use free cash flow statement and other valuation statement to analyze the value of the company. So all these things we have discussed in the previous lecture. In the last lecture we were discussing about the application of financial statement analysis. Number one is evaluate a company's past and financial performance and explain how a company's strategy is reflected in past financial performance. Second application of financial statement analysis is Forecast a company's future net income and cash flow. Next is role of financial statement analysis in assessing the credit quality of a potential debt investment. Fourth application was use of financial statement analysis in screening for potential equity investment. Next application is appropriate analyst adjustment to a company's financial statement to facilitate comparison with another company, or industry comparison can be done here. And in this today's lecture, I am going to discuss the limitations of financial statement analysis. The financial statement analysis has some limitations, hence the interested party should keep all these limitations into his or her mind while making financial statement analysis. Number one is not a substitute of judgment. An analysis of financial statement cannot take place of sound judgment. It is only a means or instrument to reach conclusions, and ultimately the judgments are taken by an interested party or analyst on his or her intelligence and skill. So this is the skill of the analysis of financial statement is the intelligent skill, and it is depend totally on the analyst. And it cannot take place of a sound judgment. It is only the instrument to reach conclusion, and judgments are taken by an interested party on the basis of intelligence and skill. Second limitation is based on past data. Only past data of accounting information is included in the financial statements which are analyzed. The future cannot be just like past. Hence, the analysis of financial statement cannot provide a basis for future estimation, forecasting, and budgeting and planning. So based on the past data, we cannot forecast. We obviously we can forecast, but the future cannot be just like a past. So the analysis of financial statement um, can become a future is basis, future estimation basis, forecasting or budgeting or planning basis, but sometimes it cannot be like that. Means it will happen is not sure, because always future cannot be just like a past. So this is the limitations of financial statement analysis, that it is based on the past data. Next is a problem of comparability. The size of business concern is varying according to the volume of transactions. Hence, the figure of different financial statements lose the characteristic of comparability. In comparison, size of business is not same always. So when one company looks stronger or better than another company, then we must think about, or analyst must think about the size of business concern and volume of transactions, and figure of different financial statement lose the characteristic of comparability. And always comparison is not according to our interpretation. Fourth limitations of financial statement analysis is reliability of figures. Sometimes the content of the financial statements are manipulated by window dressing. If so, the analysis of financial statement results in misleading or meaningless. Means sometimes financial statements are manipulated. Some extra information cooked up there, and sometimes underestimations, undervalued figures can be there. So this is the very serious limitation of analysis of financial statement, that is a reliability of the figures and the trueness and trust we can put on the figures depicted in the different financial statement instruments such as balance sheet, then income statement, cash flow, current cash flow, etc. So the reliability of figures is the serious limitations of financial statement analysis. Next is various methods of accounting and financing. The closing stock of raw material is valued at purchase stock cost. The closing stock of finished good is valued at a market price or cost price, whichever is less. In general, the closing stock is valued at cost price or market price, whichever is less. It means that the closing stock of raw material is valued at cost price or market price, whichever is less. So an analyst should keep in view these points while making analysis and interpretation, otherwise the result would be misleading. So different understanding of different concept of various methods of accounting and financings should be clear in the mind of analyst, and interpretation of various accounting and financing methods can be different. So the analyst should keep in view these points while making analysis and interpretation, otherwise the result would be misleading. Next is change in accounting method. There must be uniform accounting policies and methods for number of years. If there are frequent changes, the figures of different periods will be different and incomparable. In such a case, the analysis has no value and meaning. So, there should be uniform accounting policies, methods, and standard methods given by standard boards. If the frequent changes happens in the accounting methods, or different methods are used in the different time period, then the analysis has no value or meaning, and the analysis can be misleading in case if the changes happens frequently in the accounting method, and accounting methods are different and used differently, and if there is no standard approval or standard maintained in the accounting methods. Next limitation is changes in the value of money. The purchasing power of money is reduced from one year to subsequent year due to inflation, and it creates problem in comparative study of financial statement of different years. So if we want to compare the financial statements of different time period, then the value of money is the matter. Changes in the value of money is the matter because of changing scenario, inflation and deflation and business cycles continuously happens in the economy, and this leads to the problem, or it creates problem in comparative study of financial statement of different years or different time periods. Next limitation is limitation of the tools application for analysis. There are different tools applied by an analyst for an analysis, even though the application of particular tool or technique is based on the skill and experience of the analyst. If an unsuitable tool or technique is applied, certainly the result are misleading. So the serious limitations can be arise uh, from the tools and applications for analysis, or tools and different methodologies applied for the analysis. So the problems can inherently come from the tools and applications if used in a wrong way. So if an unsuitable tool or technique is applied, certainly the result will be misleading. So analyst must care, and analyst must apply the tools and application according to the standard methods. Next methods are no assessment of managerial ability. The result of the analysis of financial statement should not be taken as an indication of good or bad management. Hence, the managerial ability cannot be assessed by the analysis. Sometimes manager or managerial ability leads the company or a firm into great success, but and sometimes management is good, but some external and internal environment or factors happens in such a way that managerial ability get into the question. And here we cannot judge the managerial ability by just assessing the financial statement. Next is change of business conditions. The conditions and circumstances of one firm can never be similar to another firm. Likewise, the business condition and circumstances of one year to a subsequent can never be similar. Hence, it is very difficult for analysis and comparison of one firm with the another firm on the basis of financial statement analysis. So the external environment or internal and external business environment sometimes different for two different type of companies, which we are going to compare with the help of financial statement analysis. So sometimes the business conditions are different, and these are not depicted in the financial statement analysis. So it is very difficult for analysis and comparison of one firm with the another. So friends, that is from my side in this today's lecture under the title of limitations of financial statement analysis. If you have any, I hope you understood somewhat. If you have any problem questions, then let me know, write to me, or you can message me. Thanks for watching. See you in the next lecture.